2024 has been a wild ride for real estate. With interest rates in the high 6s and low 7s, you'd expect real estate prices to drop. But instead, many homes are actually selling for more than what they were 2 to 3 years ago. So what does this mean? It means that people are now paying more every single month for the same properties if they bought them 2 or 3 years ago. And because of this, how much home they can afford every single month has changed drastically. So in this video, I'm going to be sharing with you exactly how much home you can afford based on your salary. But before I give you the actual numbers, I want to share with you how home buying actually works. Typically, most people do not buy homes in cash, meaning they don't just pay for the entire thing themselves. What they normally do is put as little money as possible in the form of a down payment and then get a loan for the rest. And the standard practice is to put 20% down and have the lender give you 80%. And then of course, you have to pay for any closing costs or repairs out of your own pocket after that. But with some lenders, you can even buy properties with as little as 10%, 5%, or 3% down. It all depends on what loan you get. But by putting in less money, you now have a higher monthly payment. And you're gonna have extra costs such as PMI or private mortgage insurance. And by having a lower down payment, you may even need to pay more in closing costs. So you really have to find that right balance between what you can put down as a down payment and how much you can stomach paying every single month as a monthly payment. Now, another thing to note is that lenders will only give you a loan based on what you can actually afford to pay every single month. Like for example, a lender is not going to let you just buy $1 million property for just 3% down or $30,000 if they know you're only making $40,000 a year. Because at a 7% interest rate, your monthly payments on a $970,000 loan will be $6,878, way more than the $3,333 that you'll make for your salary before taxes. So they want to make sure that you have the money to sustain the monthly payments. And that's why it's important to understand how much you can realistically afford based on your salary. And so what it really comes down to is how big of a loan can you actually get to buy a home? Now this next tip is very important, so listen up carefully. Most lenders will do their best to give you the largest loan possible based on your salary. However, I suggest buying something a little bit below that minimum, because if you end up taking the largest loan that's available to you, then you may end up house poor, which means that most of the money that you make from your full-time job will go towards your housing payments, leaving you with very little money to do anything else. And honestly, that's no real way to live a life. So even though the numbers I'm telling you today may be a little bit lower than what the lenders will tell you, I suggest you take my advice because this will enable you to buy something that you can comfortably afford instead of just maxing out on what you can get. So based on the salary that you're making, here's a chart of what you can afford, assuming that you have no other debt and you're putting 20% down. So if you're making $60,000, then you can afford a $300,000 home. And if you're making $108,000, then you can afford a $601,000 home. And if you're making $180,000, then you can afford a home over $1 million. Now you might be wondering, how did I get those numbers? Well, the way that most lenders look at how much you can afford is based on something called the debt to income ratio. Debt to income ratio is when they take all of your outstanding debt plus the principal, interest, taxes, and insurance that you're gonna have from this new property you're gonna buy, and then dividing it by your gross income. And that means your salary before you pay taxes. Now this top line for your debt are all the fixed costs that you have to pay no matter what. So even if you don't go out at all, you stay home and cook all of your meals, you don't go shopping one time, you still have to pay all of these things. Now the bottom of this equation is your gross income. So your gross income is how much money you make before paying taxes. So if your salary is $60,000 a year, then your gross monthly income is $5,000 a month, because that's 60,000 divided by 12. So what the lenders do is they take that huge top line debt number, divide it by your gross number, and they want to make sure that this number is below 43 or 50% depending on what kind of loan you're going to get. For our cases, we recommend that you keep a debt to income ratio below 40%, because if you're really maxing out and going for a 50% debt to income ratio, then after paying taxes on your money and paying for any other expenses that may occur in your lifetime, you're really not going to have much to spend on anything else, and you're going to end up hating owning your house. Plus, if anything happens like your water heater goes out or if you need a new roof, then you're going to be in a very, very tight spot because you'll have no savings. So to calculate these numbers and find out exactly how much you can afford, first we assume that you had no debt. You don't have any student loans, you don't have any car payments. We only looked at the principal, interest, taxes, and insurance and divided it by your gross income. So if you're making $60,000, then your gross income is $5,000, and we put that in the bottom. And since your PITI, principal, interest, taxes, and insurance, should be less than 40% of what you're making, then we multiplied that $5,000 by 0.4, leaving us with $2,000 for the PITI. And if we assume that your taxes and insurance are around $4,800 a year, that ends up being $400 a month, which leaves you $1,600 that you can actually pay for the principal and interest, which is the loan that goes towards the bank as your mortgage. And then what I did was I put that number into a reverse mortgage calculator at 7% interest, which gave me a loan amount of $240,000. After I backtracked that in with the down payment, that led me to a maximum home purchase price of $300,052. Now let's say you do have student loans. How does that change the equation? Let's say you had a minimum payment of $200 a month that goes towards your student loans. So now instead of having $1,600 a month to pay for your mortgage, now you only have $1,400. After doing the back-end calculations, the loan amount is now only $210,000. And after adding in the 20% down payment, now your total is $260,000. So this is almost $40,000 less than if you had no student loans. Now you can see how having extra loans and extra debt really puts a damper on how much you can afford. Also, your credit score makes a difference when buying a home as well. When you have a lower credit score, banks will typically charge you a higher rate for your mortgage. If you go back to the example of you making $60,000 a year, but instead of getting a mortgage at 7%, now you're getting a mortgage at 7.5%. So in this case, you still have $1,600 to pay for your principal and interest payments, but instead of a 7% loan, you're now at a 7.5% loan. Then now your maximum loan amount is $228,828. And after adding in the 20% for the down payment, the total amount you can afford is $286,000. So that's around a $14,000 difference between having a better credit score and a worse credit score. So now you can see by having the best credit score, no other debts besides your mortgage, and earning as much income as you can, will allow you to afford the most home possible in 2024. Now, if you guys are looking for a home, but you don't have an agent that you know that can help you, then I suggest checking out Home and Money with the link down in my description. They'll connect you to a local expert in your area who can help you find the perfect home, whether it's a rental property or for your own personal dream home. And if you're thinking of buying your first rental property, but you're not sure if it's a good deal or not, then check out this video where I teach you how to analyze rental properties. Thanks for watching, I appreciate you, and I'll see you next time. Take care.